is Portnoy the greatest deal maker of our generation? Let me lay this out for you. He sells his company for $500 million.
Before taxes.
Oh, yeah, you're right. Loser. They close the deal, and within a year of finishing the transaction, they sell it back to him for $1 because they need Disney, and Disney wants, nothing to do with Barstool.
How about this? Let me posit you this. Is this a win-win-win? Like, didn't Penn win as well?
I think everyone wins.
Yeah.
I think Dave now can run this company the way he wants until he dies. He doesn't have to do anything ever again. Disney is in the sports betting business.
And now that Portnoy didn't lose, but he can't ever sell, and he can't have any sportsbook advertisers.
No, he can sell. If he sells, he owes half the proceeds.
No, I know. I'm not saying he can't, but now he won't. And he can't have any FanDuel, no DraftKings.
Okay, fine.
So he wins with the caveat. Penn wins because they're doing.
But he doesn't need the
Disney.
sports. He doesn't need the sports book advertisers because he could sell High Noon until the cows come home.
I'm just making this up that was probably their biggest advertiser. Pre Penn.
Fine.
Yeah.
Agree.
No, everyone wins.
I feel like it's.
And Portnoy looks like a genius.
Here's my one loser.
Great deal.
I think ESPN looks desperate.
Oh yeah, thirsty. They like why couldn't they start their own? Why do they have to buy one?
Is this ESPN Disney doing the How Do You Do Fellow Kids?
I mean, I guess they had no choice, but it's surprising that ESPN had to partner on this.
DraftKings and FanDuel are a combined 70% of the market, which I didn't know until yesterday.
And who's the other third? Like MGM, Caesars?
They're tiny though.
They're
tiny and they're burning money like there's no tomorrow.
Yeah.
Does ESPN instantly become like 20% player just by virtue of the brand?
I think there's gonna be like betting into the TV, like with like the new TVs. There's gonna be like in the remote.
No, but think about it. ESPN can show an NBA game, and bomb you with ads for ESPN Bet in a way that nobody else can. Like FanDuel doesn't own a TV network, so I think they're a player.
Yeah. Oh, for sure.
Plus, all those ads just come right off the TV, right?
Yes.
Instead of advertising on ESPN.
That's a great point.
They lose all that access.
They
right?
lose. Yes. Right. Where does FanDuel advertise now?
Big Ten Network.
Animal
Fox.
Spirits.
Or does ESPN have to allow them to advertise? Is there
Why?
some kind of anti-competitive? I don't know. Maybe not.
But doesn't that mean that all the sports leagues, the NFL and NBA, have ESPN by the balls now? Like, you can't.
When didn't they?
Well, they're even worse though. They have no negotiating leverage anymore because they're going to have to keep buying those contracts.
Well, if you believe the press report, yeah, you're right. If you believe the press reports, one of those leagues is maybe going to take a stake in ESPN.
That's smart.
Like they should actually sell a stake to the leagues, like 5%, something.
But don't you think at some point, like one of the other players is going to come in, like Amazon's going to come in with like an over-the-top offer for NFL?
They did. I mean, they stole Thursday Night Football.
Mm-hmm. And you think that's the end of it?
No.
And you've never watched a Thursday night game again, right?
I mean, I'm still watching them. If they put Mahomes on, I'm going to watch it. I don't really care what channel it's on.
So the Thursday night games used to be on NFL Network, right? And now you have to watch it on Prime, right? Is that the deal?
It was on NFL or
it was on NFL Network.
I thought it was on NBC on Thursday nights. Are you sure?
I mean, no.
What night does NBC have football then?
Sunday.
It's Sunday night. Okay.
And who's Monday night?
But
ABC?
they stole Al Michaels too in the process. Yeah. Amazon. Listen, I think if you could sell your company for $500 million and then buy it back for $1, the details don't matter.
Right.
It's
a short seller right there. Perfect short sale.
It's a perfect short sale.
That's true.
You sold it at the top, bought it back at zero.
He round trip Penn like perfectly. Like that's respect.
Yeah. Anyway, congrats. All right, how many minutes out are we? We looking good?
Yeah, 1 minute.
Okay.
So
you seem more nervous than usual. You okay?
I'm fine.
Yeah, you sure? John, what do you think? Is Duncan a little frantic today?
It's been an exciting one.
Bob, that ETF nope. Do you know what the assets peaked at?
He raised $65 million.
It's not terrible.
But it peaked lower than that because, of course, it lost 50%. So
do you know about this, Josh?
No.
So is it Noble Absolute Return? That was the name of the ETF?
yeah, I think something like that.
Launched and just really swung for the fences. Was shorting Tesla, maybe was long like the SQs and went. I think the fund fell. The return was like down 60 in 9 months or something. And he shut it down.
Who is it? Whose fund is this?
I don't know who it was.
Nope.
George Noble. I don't know who George Noble is.
I read about this yesterday, but I never heard of these people at all.
I mean, it was he was going for.
Do we know anybody involved with this?
I don't.
How bad were the returns?
I think it was down 60.
Yeah, it was down 65% since the start of the year.
But they said
worst ETF of all ETFs, down 65% at one point.
Tough. Listen, as you know, it's all about timing.
It is all about
and you
timing.
Can't control that.
Right. You're either in it for the long game and it's gonna play out over 3, 4, 5 years.
Or you get lucky.
Or you go all in on lucky. And
I'm also guessing losing 60% in any cycle is probably not good.
But is that what they said they were going to try to do?
Lose 60%? No, they did not say
no,
that was not in the perspective.
But they said, like, we're going to swing for the fences.
Oh, I mean, dude, the holders were nuts. You're not.
We're shooting for a capital loss right out of the gates.
Yeah.
It's
right there.
It's a
Top line of the prospectus. This goal of this fund is to achieve capital.
All right, let's do this. Let's go.
All right.
Free classes.
All right. Thank you, John. What episode is it today?
Come on, friends. Episode 105.
Today's episode of The Compound and Friends is brought to you by X-Trackers. X-Trackers by DWS provides investors with innovation, access, and value through its established ranges of ETFs across FX hedged equities, dividends and factors, China, ESG across equities and fixed income, high yield, and now thematics. X-Trackers recently launched its first 3 U.S.-listed thematic ETFs focused on innovative growth trends of the future like U.S. green infrastructure, semiconductors, and cybersecurity. To learn more, check out the link in the show notes. That's X-Trackers by DWS.
105. Oh, my God. All right. Hey, everybody. Welcome to an all-new episode of The Compound and Friends. My name is Downtown Josh Brown, and boy, do we have a treat for you today. First things first, the regulars. John is here. Duncan is here. Nicole is here. Rob is here. Sean is here. Dude, is this your first sit-in?
Second.
Okay. For people who don't know who Sean is, he is the guy these days, since Michael abandoned me, who makes me look really smart on television. I almost don't open my mouth without Sean supplying the information that I need so that I really sound as authoritative and as incredible as I do on TV. But that's mostly Sean these days, not Michael anymore. And only a little bit me.
Credit to Sean.
Is that why Michael reacted so badly to that chart this last? What are your thoughts?
That was some lazy ass shit. That was terrible.
He's jealous of
Stand
Sean.
by that chart. Terrible garbage.
Sean is going to move to New York. He's going to be a rising star within this organization, and Michael's going to get really catty. You'll see. You'll see. I've seen it before.
I love you, Sean. I love you, Sean.
All right, we're so lucky to have you, Sean. Welcome to the studio. Ben Carlson's in the house tonight. Give it up for Ben.
Confident in my assertion.
Do your catchphrase. You have anything? What do you got?
What? Wait, hold on. What is that? That was
You have
loud.
no idea what's going on here.
Stop it.
Give me your catchphrase. What's your thing? What do you say when you like Michael goes hello hello? What do you do?
No, that's probably you confident in my assertions.
Very
All
confident.
right, you won't do it, I'll do it.
My whole shtick is like there shouldn't be an intro for podcasts.
And yet
I was about to say, Ben,
Just start talking.
You know this is a show, right? There's a too long.
we're working on minute 7 of my intro here. So how's it going so far? Ladies and gentlemen, our guest today,
The star of today's show.
the star of today's show, and we've been looking forward to this episode for a long time. Bob Elliott is here. Bob is the co-founder, CEO, and CIO of Unlimited Funds, an asset manager providing easier access to hedge fund strategies. Bob was previously the head of Ray Dalio's research team at Bridgewater. Bob Elliott, welcome to the show.
Thanks for having me, guys.
How much of Bridgewater's returns do you want to take credit for now? You have an open mic.
All
so-
of the positive returns.
Okay. Would Ray do what I just did for Sean? Would Ray ever do that for you?
Every
might.
once in a while. Yeah.
In what outlet? Like on the phone with you, maybe?
Yeah,
Okay.
maybe.
Well, we're gonna do an airing of the grievances for him working at Bridgewater.
Before
we don't have all day, you know?
Actually, I missed something. Before we even get started, I want to give a shout out to Michael Sembalist, who was on the show a couple of weeks ago, and he mentioned our show in his note, Eye on the Market, and he said, quote, "I never do media appearances, but I did accept an invitation in July to speak on a video podcast." That's what we're called now, Duncan, a video podcast.
He's a boomer.
Called The Compound, which is moderated by money manager Josh Brown. The reason I accepted, it's a long-form, 90-minute show that allows for in-depth discussion and debate that does not occur in any other media I've seen. What a really nice, isn't that nice?
So nice.
I listened to his podcast.
He was
He
great.
said he got a new mic because of this show.
He got a better mic now. He's stepping up his game.
He was phenomenal. Nobody knows how we got it done, but credit to you, Josh.
For sure. Anyway, Bob, tell us how great our show is. No, so let's start with who the hell are you? Because I used to be on Twitter and you didn't exist, and now you're the only thing anyone wants to talk about. You are like a superstar. You're like out of nowhere. When did you like come to everyone's attention?
Honestly, I started on Twitter about a year ago.
That's why I didn't
more
know.
Than a year ago. Because when you're in the hedge fund space, you can't be out there talking about your positions and stuff. And I started it. The basic idea was I just had some friends, some old colleagues. I was like, I'll just write down the stuff that's on my mind, just put it out there so we could talk about it instead of it being over a text chat or something like that. And it started getting picked up. People were like, oh, that seems pretty interesting. And still to this day, all I do is I wake up in the morning, write what's on my mind,
Can I tell you
commute home,
write
what's on my mind. That's it.
What you're describing is literally the way that everybody we like and respect in this game got started. Like, nobody that we like look up to, or nobody's like, I'm going to become an expert on the market and sell my bullshit on Twitter. Nobody, everyone that we like, including ourselves, is like, you know what? I have stuff to say. I have no idea if anybody cares. I just feel the need to write it down and put it out there, and let's see what happens. And that's like the most honest way, I think, into the business. So congrats on that.
Thanks. I mean, I spent almost a decade writing. Bridgewater's got a very famous thing called Daily Observations.
Yeah.
I was writing them, a couple times a week, which is basically the same spirit, but a more institutional capacity. And that's how I process markets. That's how I think about markets, is just basically see what's going on, think about, what are the questions, the topics, the trades, all that stuff that's on my mind, and then just put it down on paper. And Twitter is such a great environment, right?
Oh yeah, it's amazing. I love it.
It's efficient. It's efficient. It's to the point.
Great for sharing information.
Yeah, and
you'll hit it. You'll hit it soon.
Most of the people are pretty good.
Stick around.
No, wait, hold on. Before
make some like big jumps in your career from here. Like your unlimited funds gets to name a milestone.
Once you get to $1 billion, it's over.
And you'll see if you're still having as much fun. Sorry.
So Bridgewater is not an easy place to get into. It's certainly not an easy place to rise in the ranks.
Yeah, how did you get in there? It's like 150 employees.
Well, back when I started, it was around 100. Yeah, 100 employees, and it was the challenger in the space. People thought, systemizing macro was kind of an oddball idea, right? Most of the macro was like Soros and big bets, big swings, speculative positions, and so Bridgewater was sort of on the outside looking in, and I was part of the small handful of investors that took Bridgewater from where it was then to being the incumbent.
Right.
Which was a great, what a great environment, great time to be trading markets.
Was it your first job out of school?
It was my first job out of school, yeah.
When did you start there?
I'm guessing you did not go to Queens College like me.
I did not go to Queens College, although our co-founder went to Queens College.
In another generation, though.
a whole other generation.
Yeah.
So a lot of respect for Queens College graduates, for sure. I'd done a lot of work in public health when I was in college, and realized economics was what really drove public health outcomes globally. And so I was like, I'll go there. I'll basically get a master's degree in economics. They'll pay me for it, which is a pretty good deal. And I stuck around for almost 15 years,
From the time that you started at Bridgewater until you departed, it went from being like kind of a scrappy hedge fund to the pinnacle, like in terms of like performance, culture, the renown that the firm. What was that like being on the inside of arguably the most successful hedge fund in history, or one of them? Let's say top 5. What was that like to witness?
Incredible,
be a part of
incredible growth, incredible time in markets, the financial crisis, European debt crisis. All of these different experiences that I think shape a lot of how I think about the world, think about markets. Being on the inside, essentially, when the financial crisis was happening, talking to regulators, banks, insurance companies, seeing how that played out. It was about as fast as you could learn about markets. That's a
1 in a million opportunity, maybe 1 in a billion opportunity.
How is radical transparency for you?
Fine. I think there's a lot of folks drama around it and sort of like intrigue about it. Like all it is it's not that much different.
So it's overblown.
Sorry, Bob is referring to the culture at Bridgewater, which notoriously is like something people from the outside like to make jokes about.
Well, because it said that it's been reported that there are baseball cards on employees and everybody's being graded and everything's recorded. And is that overblown or is there truth there?
Think, at its core, it's just no different than any other high performing organization. When you get people in who are running money seriously, you sit there and you have direct conversations about what's going on, and you don't screw around. And whether you look at Netflix and what they write about, or Bridgewater or other high performing places, that's basically what it is.
Ritholtz Wealth. Let me read this to you. This is Matt Levine. I never understood how Bridgewater gets any investing done, but of course, there's a computer that does the investing. One stylized model for thinking about Bridgewater is as run by the computer with absolute logic and efficiency. In this model, the computer's main problem is keeping the 1,500 human employees busy so they don't interfere with its perfect rationality. So all the games of grading each other and recording meetings is to make sure nobody accidentally touches something on a keyboard. It's funny. It's Matt Levine. But take that apart. It's not obviously not real.
I would, there was a core of folks who were running the money that, you probably have seen. I was part of that group. And, I hate to say it, but it was a whole lot less interesting than all of this intrigue that you read about on the internet.
Imagine they start writing articles one day about what's the if that's Bridgewater model, what's the model here? Right. I guess nothing looks good if reporters or columnists are deliberately trying to make fun of something for
I mean how interesting would a story be? It's a bunch of people working hard to try and figure out how to trade markets. And
doing Excel all day
and doing that every day. That's not that interesting. It's not that interesting a story, but closer to the reality than
is it everyone there a type A personality though? Is that really how it is? Or is it a wider range of people than you think?
I wouldn't quite say that. I think the thing that the best people who are there are people who are just incredibly intellectually curious and just fascinated by how does the world work, and not about markets and economies and all that stuff, but just broadly, they're broadly thinking about everything that's going on. And so that curiosity is what creates the questions, which creates the differentiated insight, which you have to have in order to generate alpha. That's really at the core.
I want to start today with global macro in general as I guess it's not an industry, it's a style of investing, but it's also kind of also a style of being on Twitter or being on social media or writing newsletters. It's a
persona.
It's a persona almost. And you
broke the mold.
You're iconoclastic in this way. It seems to us, knowing very little from the inside, but from the outside looking in, most of the people who have this specialization in global macro seem to be bearish, or pessimistic, or overly focused on everything that probably will go wrong. Are we wrong in thinking that from the inside? Are there many more people who are more pragmatic and optimistic, or do we have that about right? From your experiences,
I think when you run money from a macro perspective, you have a lot of you've studied every crisis, every hard time, every problem that could emerge, right? So even though, of course, in general, investing in assets should do you pretty well over time, right? The big thing is to watch out for those key times when things aren't working.
Well, that's when you make the most money,
which is when you're most differentiated relative to traditional passive investing. And so I think that's really the focus is how do you do fine in times when assets are going up and everything's kind of going up, but then when the chips are down and trouble emerges, how do you preserve the capital? How do you see it before it happens? And how do you preserve the capital? And so in that sense, I think there is what might come across as a bearishness,
it's
a bearish perspective, or an angsty.
What could go wrong?
What could go wrong?
What am I seeing that no one else is seeing?
My theory is 2008 broke a lot of brains, and so many people missed 2008 happening that they said that's never going to happen again. I'm never going to miss a crisis that big where the stock market falls 60% and the economy and financial system are teetering on the edge, and I'm going to call the next one. And
think about what it did for the people that didn't not miss it.
Yeah, you became a celebrity.
It's asymmetric.
Michael Lewis wrote about you.
They were goated. They would be goated.
So Bob, one of the things that I'm attracted to you about your Twitter account and your persona is that you broke the mold with this because you seem to be objective. I don't categorize your views as pessimistic or optimistic. They're objective, at least as objective as you could be. There's no agenda. And I think from the point of view of getting, as a money manager, especially if you have the ability to short or avoid corrections, if you miss it, you look like an idiot. How did you not see the risk coming? What am I paying you for? And if you're bullish and right, okay, whoop-de-doo.
Everyone made money.
I could just buy the SPY. Why am I paying you? But if you miss a bear market, you're an idiot. Why am I paying you?
Yeah, well, I think the main thing is the way. How do you generate long-term high risk versus return capital, or high return versus risk capital, is by going with those times when things are buoyant, but not getting over your skis and leveraging all in, and then protecting on the downside. And if you can cap your losses to being even a third of what traditional index investing is, then you're going to be wildly successful over the long term, right? And that's really, if you look at what hedge funds in general do, like hedge funds are not, they have this sort of this view from the outside that they're like, gunslinging, high vol people. They're like incredibly.
Some are,
but there's 3,000 of them. You put them together, and they most, the median manager is incredibly boring, risk managing, and trying to generate that 7, 8, 9, 10% return without too much volatility.
Well, the thing is, though, the outliers are the ones that cross over into mainstream or pop culture. Like Ackman is not boring. Soros is not boring. Einhorn is not boring. They speak, they write, they appear places, they do selfies. But that's what so when you talk to people that don't know anything, and you say hedge fund manager, that's who they see.
Of course, but but those are 10 people trying to be famous out
of 3,000.
Right, out of 3,000 that are, incredibly.
Although Ray doesn't run away from the camera. I mean, so it's one of the things about Bridgewater, the testament to Bridgewater's culture, and why I've come around, and not that I ever didn't believe, but like why I actually do believe that there's something special there. Can you think of another hedge fund where the main guy left and the successor stepped in and things actually stayed good or got better? I don't know where you stand on the Kremlinology of the whole thing, the politics, but like Greg Jensen did not f it up.
The Fresh Prince when they changed moms.
Yeah,
that's a great example.
So that's a really good example. Not a hedge fund.
Vivica?
I don't know if you want to like really answer that, but like
Viv.
I'm kind of onto something. Is there another fund where that transition has happened and the world didn't fall apart?
Oh, I mean, I haven't been there in 5 years, so I don't know all the palace intrigue.
Forget all that.
Like
Just the
but
the results. It's still standing.
Part of what I'd say is that the benefit of approaching things systematically really does help in that process, which is
the all-weather portfolio. That's about as boring. I mean, that's an index boring-ish portfolio.
For sure. Yeah, the all-weather portfolio is very boring.
Say that shit now, and then it's 1937, and you're going to be really glad that you had that boredom. It's going to be the right kind of boredom.
That's what I'm saying, though. Like you mentioned the gunslinger thing. Like the all-weather, I mean, people pay more attention to the macro portfolio, I think, but that's a allocation-based, broadly diversified, rebalanced. I mean, it's pretty simple.
Yeah, I mean, the basic idea there is, look, build a strategic portfolio that doesn't take a whole lot of effort to manage, right? That's going to protect you in a lot of different environments. And Bridgewater's run the all-weather portfolio. There's RPAR, the ETF.
Is all-weather the largest fund at Bridgewater?
I don't know. I have no idea.
Okay, but it's like, is it it's the flagship, right?
Pure Alpha is
the flagship,
is the macro fund
that one's probably more fun.
People are looking at the Alpha fund.
Okay,
let's talk markets. We got CPI report today. This is a great chart from Bespoke that I think I think I knew this. Inflation had been falling year over year, but I didn't realize that it was like really an outlier in terms of the consecutive number of months where the year over year reading was lower than the previous month.
It's a full year.
It's 12 months. Pretty wild. Yeah. It ended today, but pretty unbelievable. Bob, you tweeted today, maybe a good jumping off point for this. Elevated inflation will persist as long as nominal wage growth significantly outpaces productivity growth. Wage growth data today shows 5 to 6% wage growth on a matched basis among those with the highest propensity to spend, too high for inflation to durably fall to target.
Well, that's pretty boring, isn't it?
Unpack this.
Look at this engagement, though. Look at this.
But Bob, what do you define as elevated? Like, do you think 3% is elevated? Or
Well, I think the the Fed's target's 2.
So anything above that?
Anything above that, they have room to move to 2.5 and stuff like that. But like, look, the Fed needs to make sure that inflation is not 3, 4, or 5.
Because the thing, if you look at, I got data going back to 1914, and you can see, I don't sort of up there, but back in the 20s and 30s, the historical long-term average over 110 years is 3.3.
Right.
So that's like so why do people think that 3% is so high?
But because at 3%, you start to get the trouble with 3%, and the trouble with moving above 3% is that you start to get 2 main problems, which is one, it increases the volatility of inflation, which increases the uncertainty about forward investment and reduces long-term productivity, right? Medium-term productivity, which is really what the Fed's focused on. That's why the inflation mandate's
So you think if it's above 3, it's harder to control the volatility of it?
It is harder to control the volatility.
But why does that? Can you unpack how that impacts productivity?
Well, because a critical component of long-term investment is having a good sense of what your cash flows.
Can you define productivity for the audience?
Yeah, productivity. It's basically, investment that creates a certain amount of output per, unit of a person's time.
Yeah.
Right. And so that means factories, that means, roads, that means intellectual property, all sorts of stuff. And in order to figure out, look, there's like thousands, tens of thousands of these analysts sitting around in their spreadsheets figuring out, like, here's what the cash flow is I'm going to spend, my RRR, I'm going to spend $1 million today, and here's what my cash flows are going to be in the future. Well, it's a whole different story if you don't really know what the cash flows are going to be in the future, if there's volatility there.
Right. If it was 5% forever, we'd be fine with that.
If it was 5% and certain to be 5% forever, then we'd be fine with it. The problem is that when you move from a volatility around 1.5 to 2.5 to say 3, well, 3 can become 5 or 6 or 7.
The uncertainty.
And that uncertainty is what creates the harm to the economy, the long-term drag on productive.
You can't budget. You can't figure out what to pay people.
Right.
You almost could become frozen stiff. Like, I'm not investing in, name it, CapEx, inventory, whatever, until I feel better about what's going on.
Essentially what happens is the risk premium of all projects rises, which means projects that would have otherwise made a lot of sense in a low, stable inflation environment, now
they look riskier.
Right? Because you have to factor in that. So your cost of capital, your hurdle rate, all of that stuff goes up. That means that you're doing less investment, which means that the economy is less productive.
But isn't nominal wage growth, John, chart back on, please. Isn't nominal wage growth coming down, maybe not as quickly as you would like it to, or the Fed would like it to?
Well, take a look at that chart. Like, has it come down? Yeah, it's not at 6.5.
This is median wage growth, smooth 3-month average.
It's still pretty. So it's still well above. So this is what, 5.5%?
5.5%. And this is the Atlanta Fed wage tracker. There's a bunch of different things.
Dude, median wage growth 5.5% is disruptive to business.
This is where the normal person on the street looks at us and says, "You guys are nuts. I want higher wages." So explain to the regular person.
They want higher wages until they go lease a car.
Right.
And see what that shit costs. And then it's like, oh, maybe this isn't great.
The average car is $730 for a new.
Can we admit,
rental.
though, that higher inflation has caused a positive? You saw that the UPS thing this week of they're giving $170,000 plus with benefits or whatever.
Yes.
Like, haven't we had some positives from a volatile situation?
Yes, but the cost is somewhere else. It's trade-offs.
Yes.
I'm okay with those trade-offs.
Right. Well, I think the main issue is that the prices have risen faster than the wages.
Yes, that's why people are still not happy.
And so people are actually meaningfully worse off today than they were 3 years ago, and that's totally normal. Anytime you have one of these inflationary cycles, the prices rise, and then it takes a while for the wages to rise.
Right,
the wages don't start. All your wages for everybody in the building. Right?
Don't get started.
Yeah, come on.
What are we doing here?
No, it's not you, Bob. No, wait, but real wage growth just went positive. But I'm guessing if you were to do it cumulatively, it's definitely lagged.
That's right.
For sure.
That's right. And that part, just important to recognize that the level of prices, particularly food and energy and things like that, most significantly impacts the lowest wage earners because they're spending on those goods, right? And they can't change, whether you buy a $700 a month car or $600 a month car, you got wheels that takes you where you need to go. If you got to buy your food, buy your gas to get to your job, like, you don't have a choice. And so that's why there's no more regressive tax than inflation.
But this time, the lowest income workers...
Regressive meaning there is no tax in the economy that more specifically hits the lowest income earners.
But wasn't this time unusual in the sense that the lowest income workers actually had the biggest nominal wage growth?
Sure,
after being held back for 20
after
years.
being held back for years, plus the fact that the prices have still meaningfully affected.
You're saying this is every time, though? This is the cadence of it.
Always, right? Because those people who are most sensitive to price rises are those people who have to spend on a certain basket of goods.
You see how the UAW opened up negotiations last week with the automakers? They said, let's start with a 40% wage hike. That's their opener. And then a 5% rise every year for the next 4 years or something.
Yeah, it reminds me of the good old days in Detroit.
Punch them in the face as your first negotiating tactic.
That's right. And that gives you a sense like that's all catch up, right? Everyone's still facing the rising costs and the wages need to catch up. And so when we look at that inflation chart and we tick 3%, well, just think about all of the additional negotiations that we have, all the people who haven't had their wages rise, right? All the people who, they need a year or 2 years or 3 years for those wages to rise.
In pop culture, all the great movies about labor took place in the 70s. They didn't come out in the 70s, but like mid 70s to early 80s. It's not coincidental. And let's put up this Jeff Kleintop chart, John. He says it's funny how history rhymes. You're looking at U.S. CPI year-over-year change, 1966 to 1982 versus today, 2013 through 2023. And he's basically overlapping them. And it could be an identical rise and fall.
I'll take the under on this one.
You take the under on what? It's not going to look like this?
No, well, in the mid-70s, you had this monstrous spike, and then it came down, and then it re-accelerated. What do you think would have to happen for inflation to reaccelerate?
I think probably, what happened here, which I think is
specific. This is oil related.
Somewhat indicative is, you didn't have the second oil shock until that 78 and 79 acceleration. I think the most interesting point is the 76 and 77 period where you did see that bounce up in inflation and it was stable at too high. Right? It wasn't surging. It wasn't extreme.
Yeah, the absolute levels are way higher there.
This is an oil embargo. This is an oil embargo. This is specifically the Saudis and the Iranians holding back oil from the market because of a war with Israel. But then that kicks off something bigger in the economy. But it's like it had a root cause in the same way that we were going to have inflation no matter what this time. But what really kicked it into gear was Russia invading Ukraine. Like undeniable.
What oil prices would have to go to match the 70s on a magnitude level?
300.
So in the 70s, it went from 2 to 34. So to match that now, it would have to go like 60 to 1,000.
$2 to $34?
That was the 70s. So we'd have to go to $1,000 a barrel to match the 70s.
The levels aren't the same. But I think the dynamic is the same in the sense of once you get that inflationary impulse into the economy, what you get is people start to reset their wages, negotiate for the higher wages, and spirals are not a thing. Spirals are a thing in emerging market crises. In developed economies, spirals aren't a thing.
The wage
price spiral?
You don't think that's a real phenomenon?
It's not a phenomenon in terms of what's going on in the U.S.
But doesn't that make the 70s unique, though? That was like the only time that happened.
Well, what I'd call it is like maintenance of elevated prices, right? What happens is prices rise, people negotiate for higher wages, and then when they negotiate for higher wages, they increase their nominal spending. And it maintains. This is a maintenance of elevated inflation. And so you see that chart of the wages at 5. And to be clear, you have to compare it to productivity, right? So the wages are at 5, but productivity has been as weak as it's been in decades. So productivity has been 0.
Do we have a measuring problem with productivity?
Well, I don't think so.
We're not counting the right stuff.
Well, I think first of all, a lot of us
they're not even counting tweets.
A lot of us, right, have. A lot of us enjoy maybe a better life experience. Who knows?
The hedonistic adjustment. What is that called?
Well, no, it's consumer surplus.
Hedonic.
That's the thing is we mostly experience consumer surplus, right? We're not actually, I write a lot of tweets. It's like nobody's paying me for it, right? I'm waiting for my check from Elon. I'm getting my 5 million engagements a month and no check in my inbox here.
Yeah. Are you a Twitter Blue subscriber?
I am.
So you should be.
Waiting for it. I'm waiting for my $100 to go buy a sandwich, right?
Right.
And but I'm not getting paid for it. So you all are enjoying the benefits of, insights and knowledge.
It's entertainment.
And how much GDP have we established as a result of that?
None.
Zero. Like there's a little bit of GDP with those Cheech and Chong, gummies that are on advertisements.
That actually might be detracting from.
But
GDP.
I think probably is. So
there's activity that's not necessarily economic activity,
which is consumer surplus activity, beneficial. We all are better off for it. But who is paying what for it? And that's the real issue.
Okay.
So I would like to ask your take on wages. I would defer to you, obviously. But in my estimation, most of the wage gains are behind us. And the reason why I say that is because, or the line share, when you look at the chart of, I think the Cleveland Fed might do this, job switchers versus job stayers, and you deconstruct the wage gains. The job switchers chart, the Great Resignation, whatever it was, the job switchers chart went parabolic, and then it came all the way back down. So what would cause, now they might stay elevated, but what would cause, again, a potential reacceleration? Like, haven't employers digested most of that?
We're gonna have the quiet quitting stuff continue, or
I don't think
the
so.
jolt spikes.
Hey, guess what? So my train today was packed. WeWork is going out of business. Amazon just put out a really, not nasty, a pretty aggressive letter and come back to the office. A lot of these office property REITs are doing pretty well off the lows. People are coming back to work.
Yeah, sure.
Well, isn't the biggest difference between now and the 70s that there was way more union power back then? And sure, there's some union power being exerted right now by some big companies, and that's happening, but nowhere near what we saw.
It's not
back
the
then.
Irishman. We're not blowing up taxi cabs.
But that's, inflation was double, in the high double digits, then, right?
Yeah.
So I think the question is, can we see persistent 5% wage growth in this sort of environment?
That's what you're asking,
my
right?
point
Until you start to see significant labor market weakness. And I think the answer is yes. Why wouldn't, what about, and this is what, when you get these inflationary shocks, right? The thing that determines whether there's persistence is whether labor markets are tight. And labor markets are tight. Any
Very
of you who read my tweets
Secularly tight.
Secularly tight. Every Thursday, labor market secularly tight.
Told you I'm a fan. but my point is, if employees were going to go to their employers and say, listen, I can't afford to live. Okay, hasn't most of that been done? Here's an analogy.
Look at the level of real wages is down from where it was before. People are still behind.
Understood, but employees, so we spoke all last year about how it was actually a good thing that for the first time in decades, labor had the upper hand over capital. That dynamic is changing with, not that any employee is going to their employer, hey, headline
It's not across the board.
Headline CPI is 9%, I want more money, but with inflation coming down significantly, they don't have the same leverage that they did a year ago.
I think, first of all, the levels matter. They're still behind, and so they're still negotiating. And that takes time, years to.
Yeah, I'm not saying it's over.
And number two is, I think people are often confused about the labor market. Like, we had a labor market 18 months ago that was like the equivalent of a labor market that was like a 2% unemployment rate. I mean, it was so hot, right? It was scorching hot. And so now we're looking at a labor market that's like, hot, right? Tight.
Right, not 2022.
Not 2022, which was the most extreme, tight, hot
labor
labor market we've ever seen.
Still too hot, but not extreme.
Still too hot, but not as extreme. And I think people are confusing the difference between, those two levels. The labor market today looks nothing, is so much better than what it looked like.
There might be economists that think somebody takes the CPI report and waves it in their boss's face, theoretically, but in practice, I don't think that's the thing that happens. I don't think that you'll get it'll remain tight for that reason. I just think the demography, we have no immigrants, legal or illegal, for 6 years. It's a really important component of the service industry, whether we want to admit it or not. You had a whole bunch of people die and get really sick. You have the boomers they're
retiring.
But then you see labor force participation rate uptick in the July report meaningfully. And you know who it is? I know. I'm asking, do you know?
Well, most of the people who are coming to the market are the prime age, right?
Who's rejoining the labor force?
Yeah, it's women.
It's women 25 to 34. They have kids, and because of remote work, they can also work. It's not prohibitive anymore. It's an amazing thing. It's great. I think it's great for America that not only is the labor force participation rate ticking up, people are coming back to work. It's people that a generation ago could not have come back to work because they have a 5-year-old at home. And now it's not that way. So there are, to your point, there are silver linings of a really hot labor market and really high, wage growth.
I have a market question for you on this. So I agree with you behind like the psychology of inflation. Just the longer it's here, the harder it's going to be to get rid of. Why doesn't the bond market care? The 10-year's still at 4%. That seems high relative to 2 years ago, but relative to history, 4% is still very low. Like, why is the bond market not cared yet?
Well, I think there's this basic sense that inflation is going to go back to 2%, right? Like real yields have moved up a reasonable amount.
So you think they're giving a lot of credit to the Fed or faith in the Fed here?
Well, I think, everyone talks about the bond market as the smart money, and I'm reminded of the bond market dynamics in 2009 and 2010. I don't know if you guys remember that as vividly as I do, but in that period, the bond market basically said, look, we're going to get a return. We're going to get a normal cyclical bounce coming out of the financial crisis. And instead, we had 10 years of very weak
balance
conditions,
sheet recession.
Right? Yeah. A traditional balance sheet recession, a deleveraging as it's sometimes called. And the bond market basically priced in, we're just going to go back to what we've always expected, right? And it took a lot. It took years for that set of expectations to reset. And I think we're basically seeing the same thing happen today in the bond market, which is, I joke that all the bond traders have typed in 2% into their Excel models for, break-even inflation. And then now they're trying to remember, oh, yeah, actually, that's a thing that moves around, right? That combined with the supply-demand dynamics puts together something that's creating that upward pressure on bonds.
So is that a big risk to the market then? If we see like the 10-year and 30-year go crazy, I know they've been going up and down in the last couple of weeks, and they took off and came back in.
Well, the 30 year is now at 4.25.
We're steepening it. We're steepening
Right.
it.
We're getting a bear steepening.
But is that a long-term trend where if you saw the 30-year and the 10-year really move meaningfully higher and start to price in higher inflation expectations, that's a big risk to the market?
I think so, yeah. And I think part of it is not just a risk to the market. Part of it is that's what's required to cool down the economy, right? Because what we have right now, the economy's too hot. Right, the Fed has tightened, but basically they've said we're out for the next 6 months. So but nonetheless, Atlanta Fed GDP, which is probably overstated, is running
We're
at.
We're going to go there now. Actually.
Is running at 4%. Right, we have the unemployment rate's at 3.5%. Yeah, the Atlanta Fed GDP now.
Why do we care about the Atlanta Fed GDP now? What is different? I know it's higher frequency, and they're trying to capture more real time versus lagging indicators.
Yeah, I mean, mostly it's just like if you do this right, what you do is you look at all the different stats that come out and you kind of from that infer what growth is going to look like. And the Atlanta Fed just kind of does a decent job
all right,
of it.
So tell us where this stands right now.
I mean, 4%, which is it's early in the quarter. 4%
real GDP estimate.
Real GDP estimate. It's early in the quarter. It's overstated. But nonetheless, remember the neutral rate of growth in the U.S. right now is 1.25%.
What does that mean?
That means basically the rate of U.S. growth that doesn't require people to come into the labor market. They can be met essentially with the existing, without the unemployment rate.
So how do you jump to 4?
Going down.
What are the things happening above and beyond that get you there?
Well, the thing that's super interesting about what's going on in the economy right now is we're actually seeing a bit of reacceleration of those cyclical parts of the economy. So what you had was interest rates rose. The cyclically sensitive sectors like manufacturing and housing cooled. Basically, all the froth in those markets came right off, and then we all sort of settled down. Everything settled down, and people realized that actually 7% mortgage rates, given the tightness of housing supply, is not the end of the world. And builders have come back into the market. Prices have started to rise again. 2/3 of
demand didn't disappear. It was supposed to.
Yeah, demand slowed, but because there's so little supply, the home builders are able to continue to produce homes, which is the GDP element that you're seeing in there. Plus, you have the fact that that prices are going up. Prices reach new highs in 2/3 of MSAs in the most recent period. So that's a very strong picture. And then, of course, we have to talk about the fact that there's a big fiscal impulse in the economy as well, which is extraordinarily unusual, running deficits the way that we're running in an environment where unemployment rate
is secularly low. It's for COVID.
But isn't that the biggest predictor of future inflation? Is like the demographics and all that stuff, you could see inflation coming back down and rates coming back down. But if the government keeps spending money then that's like the big tell for inflation, is it
Is
not?
the Inflation Reduction Act the most stimulative thing that the government has done in 10 years?
Yeah, well, certainly
That's funny, right?
The act was definitely not disinflationary.
Okay.
Right.
We all
Building
agree.
infrastructure is the opposite of disinflationary.
That's right.
Maybe someday down the line, but building new roads, right, at 3.5% unemployment is incredibly inflationary, and that's exactly what we're seeing. And then all the impetus to build, non-housing investment, right, in order the CHIPS Act and all that stuff, which is creating a huge amount of fixed investment into, business fixed investment associated with that, stimulated by the government. You put all those things together, and we're basically getting a cyclical easing.
Yeah.
Right?
It's crazy.
In the midst of an economy that's about as strong as it's been in, 20 years, and a labor market that's as tight as it's been in 75 years.
So what does the Fed do? What are they supposed to do?
A different Fed chair might be more aggressive in talking to the White House and being like, okay, maybe no more new programs.
Yeah, I mean,
until we put this fire out.
It's normal if you go back to the 70s, not as extreme. It's normal to get some fiscal stimulus, although this is pretty extreme given how good the economy is overall. I mean, the reality is that the Fed doesn't control the spending in Washington, and they have one thing that they can do, which is that they can, tighten monetary policy.
But Ben's question, though, I think that's the right question. It just, from not looking at the data, it just appears that the things that we do on the fiscal side have a much bigger multiplier effect than what the Fed is doing.
And quicker.
Of course.
In both directions.
That was the whole problem. The whole problem in the 2010s was that the
Zero
Fed
interest rates
was
and nobody wanted the
trying
money.
their best, right? They were just dumping money into the streets.
All they needed was stimmies.
But you can't pull
And
the
all
punch
they
bowl
needed
away
was
because what are they going to do? Raise taxes? No. That's the solution probably to fiscal policy. But there's no way in hell that's ever going to happen.
Also, fiscal policy, other than tax cuts, is rarely going to go predominantly to millionaires. Fed stimulus goes to millionaires. And what do they do with it? They just buy more treasuries.
But also,
they don't need to spend it.
If they raise taxes to get money out of the hands of millionaires to dampen their spending, it wouldn't matter, because actually it's a good segue to a chart that Bob has about there's such a disconnect. We keep talking about how strong the economy is and how people feel about the economy still. So, Bob, you tweeted most economists and coastal finance folks. You see that, Josh? Finance?
Coastal
finance. I mean, I gotta say finance.
Well done.
Got recession calls wrong because they didn't understand the strength of middle American Main Street. These small businesses are a big chunk of the U.S. economy, and the latest hard data from the NFIB continue to show pretty good outcomes. So the chart that we're showing is soft data, which is basically surveys, versus what is actually happening, not how you feel, what is actually happening. And this is about as wide a gap as you've seen, especially when the economy is strong. What the hell is going on?
Well, NFIB, remember, small businesses.
National Federation of
Independent Businesses, right?
Yeah.
Small businesses in America are like 50% of the economy.
Yeah.
Right? And
a lot of the hiring too.
And a lot of the hiring, a lot of the employment,
Yeah.
things like that. And so everyone focuses on the earnings, but this is what matters for how tight the labor markets are, because tight labor markets are in Peoria, not in New York.
So let's tell people what this looks like. The soft data fell off a cliff in 2021.
That's inflation.
And kept falling, and that's people being pessimistic because of inflation and supply channel.
Was that double bottom?
Joe Weisenthal on his
But the hard data kept rising, kept ticking, or didn't fall off as much.
So they survey people. They survey businesses. I'm sure you go into these small businesses that have that NFIB sticker. I love this survey. They mail people physical surveys every month.
Do they really?
They really do. To 10% of their members.
This is why we're anti-survey.
And they're filling out, the bubbles. And they basically ask two different sets of questions, which is the first is, and what you see in the top line is basically, have you hired more people? Are you making more money? Are you raising wages?
That's the hard data.
That's the hard data, because it's basically like, just tell me literally what you're doing over the last 3 months. And then they also ask a set of questions, which is basically like,
do you hate Biden?
How do you feel, et cetera? And
there's political bias. You look, in 16, it goes straight up.
Of course it is.
And then down.
So
Joe Weisenthal mentioned your chart on his newsletter the other day.
Yeah, that's exactly right.
He basically said, can we really trust this survey data anymore if the people answering are so politically biased that what they say does not match what they do?
Well, this is don't tell me how you feel, show me what's in your portfolio. That's a Taleb thing.
Right.
It's so true. I don't care what you say. Just show me what's
We
in your
think
portfolio.
most of the people filling out these surveys are filling them out because they're mad politically, and that's why they'll fill it out.
I'll show you. 5-star, 1-star.
No, that's a stretch. But the type of people that are inclined to answer these surveys probably lean a certain way.
Or I mean, this cohort is more conservative in nature.
Yeah, sure. It's middle America.
That's well known.
This is the cohort that's buying gold for their IRAs from Fox Business.
Forget. I don't say
gold coins. Hey, what do you mean coastal? Where'd you grow up?
Detroit.
You're a Michigan guy. I'm in Grand Rapids.
You know?
You're from Grand Rapids?
Wait, you couldn't tell by his accent?
Another Midwest snob.
See, these coastal elitists, Bob. We're the flower states.
Another northern Midwestern elitist.
These people have never walked on Main Street. They have no idea what it's like.
Exactly.
Right? They think these shiny offices is how the rest of the world lives, you know?
That's just Josh, not me.
So the one thing I learned living in
people.
Detroit area is one thing is they taught me how to drive because people drive way faster there, and that if you drove a Ford car there, you're getting run off the road. Like I drove a Ford Taurus there because I had to.
Dude, how about this bullshit that you're a Honda Accord guy? I don't believe it for a second.
What's that highway toward the Aurora Hills Mall? What is that?
Yeah, well, there's a point where like 6 highways come together.
Okay, that's what I want to talk about.
This is Josh trying to pretend that he's
no. I drove on that, not knowing anything.
In a Ferrari.
No, dude. Seriously, I was 19. I was visiting.
I told my driver to take a left.
I was visiting my girlfriend in college in Michigan. No. It's a 5-lane highway, and everyone on it is doing 120 miles an hour.
Crazy, yes.
In pickup trucks.
That's right.
It's like the Midwest Autobahn. It was one of my favorite drives
I've lived there
I've
for 2
ever
years
done.
and moved back to the other side of the state. My wife goes, "You learned how to drive."
I was in a Ford Explorer. I think I maxed it out at like 90, and people were blowing by me on that road.
So, Bob,
you're not lying.
Bob, I think the economy is pretty simple. Not to figure out or forecast, but just today it's pretty simple. People are spending money because people are employed, right? And until something breaks in that dynamic, we're going to be in this sort of regime. So you had a chart showing the slowing of consumer credit has put a slight drag on spending, but it never mattered much this cycle. By the way, I want to talk about consumer credit and the credit crunch that never came. What will make or break consumer spending is nominal income growth. All right, so we're talking about the same thing over and over. It's pretty simple.
It's pretty simple. It comes down to whether or not people are still making wages, right? Whether wage growth continues. If wage growth continues, we're basically kind of stuck in this equilibrium.
Wasn't the Fed
stuck in the equilibrium?
Wasn't the Fed saying that they needed a recession, and for people, they were kind of implying though that they needed a recession to cool off prices, and now it turns out they didn't. So did they get it right, but still get it wrong?
Hold on. Like gas prices went from $5 a gallon to $3 a gallon.
That helps.
Had nothing to do with the Fed.
That's right.
Right? You had some supply chain resolution, et cetera.
Also outside their control.
Nothing to do with the Fed. The structural, and this is the trouble, is the structural inflation pressures, which are connected to how much are we paying people versus how much they're producing. That hasn't changed much.
Yeah.
Right? I mean, it's come down. It was, we saw in that first chart, that Atlanta wage chart, it went from 7% wages to 5% wages. So, that's better than it would have been otherwise. But it's not like they've resolved that core issue. The tightening of monetary policy hasn't done enough to deal with that structural problem. And so what we'll see is there's enough nominal income, enough nominal spending that it'll kind of pop out in various places, right? So measured inflation, yeah, sure, used car will go down in price, but then I'll spend more on my hotels, or airfares will go down and I'll spend more on other services, right? Because what will determine the trend of inflation is that gap, much more so than the nitty-gritty nuances of how exactly we account for this price versus that price. Like, people have plenty of money, right? People are spending too much. The economy's too hot. We see it in a lot of different ways relative to what's needed for the Fed to meet its mandate.
Well, your point about the inflation maintenance is, I think, a good one, because I was rereading this book lately called A Piece of the Action by Jonas Serra. It's from like the mid-90s. And he talks about, it's basically how the middle class became like this powerful force in a consumer.
Got access to credit.
Yes, but his point about the 70s was, you would have thought that the 70s inflation happened and people started pulling back. And he said, no. People figured it out. So more women came into the workforce, and then people went into credit card debt, and they decided, and they also said, well, why would I not take on more debt, because inflation is good for eroding debt. So that the 70s, in a weird way, made people want to spend more money. And that mindset, when inflation came down,
that's interesting,
helped cause the 80s. But it was interesting to hear that people just at a certain point said, screw it, I'm just going to keep spending through this. And
my debt will get wiped away by the inflation.
Yeah, and that was one of the things. That's why credit card debt really ramped up then, because people said, I don't care, I'm going to keep taking on more and more debt and keep spending. And I think that mentality, I think you're right that unless people start losing their jobs, it's going to be hard to get people to stop spending at all because they get a taste of it now. It's like, well, wait, I took 18 months off of spending. I want to keep it going even longer.
I think our version of that right now, like when you go to high-end resorts in the Caribbean or you try to book like hotel rooms in South Florida for Christmas, like just anecdotes from my own life, everything's packed, everything's booked. You can't go out to dinner in Manhattan anywhere. People that have cash and no debt are making more money than ever passively. Like you just have T-bills, you have CDs, you just have your money is gushing more money.
Selling NVIDIA calls.
Well, you had I was going to talk about this later, but you
that
had
fuels more spending.
Yes.
And that fuels so it's actually counterproductive to bringing down a certain type of inflation.
And you had a point a couple weeks ago that was basically like we've had a handoff from low rates before and the people who took out that debt and fixed it to high yields now.
Right.
And you said they basically offset each other, right?
That's
like
right.
the
That's
money
right.
people are making now in their yields.
That's kind of like the sophisticated way of saying what I was trying to say.
With data, data charts.
I do stories.
A little boring
I'm a story
in terms
guy.
of tone,
Yeah.
nerdy.
No, but like that's a real phenomenon.
Fewer Caribbean resorts.
That handoff.
That's right. That's
Okay.
right. Yeah, I mean that's the basic idea. Now, of course, the households who have the two different who have the debt may be a little bit different than those who have the assets, but like recognize that the people who have the high cost, the high notional value mortgages, right, are the people who have lots of other assets, right? So when you think about that picture, like there are a lot of folks who have a lot of liquid assets, borrowed at 2%, locked that in. And for them, times could not be better, right? Wages are growing
It's
at
like utopia.
5 or 6%. Their debt cost is fixed for their most, the thing that matters the most.
And their investments are
and
booming.
their stocks are going up a ton.
Yeah.
Right. They're getting yield on their assets. I mean, pretty much the only thing that's a problem is the cars, but they're generally not financing the cars when they're doing that. And so it's fine. Like and this kind of goes to the overall picture in terms of the credit story, which is like this isn't a credit cycle, right? Credit is not driving demand. Income is driving demand. So it's fine. Interest rates rise, but it's not that big a deal because you have more than enough income in one form or another to pay for your $700 a month, auto payment.
Yeah, it's really hard to have unsustainable debts right now when everybody is working.
Everyone's working, and their wages are going up at the rates that they are.
Where do you want to go next?
Let's talk about what the market is pricing. We did a lot of econ stuff. All right, so you said, what is the likelihood 2024 will have 12% earnings growth? Now, that's just analyst estimates, what they're expecting, and 5 rate cuts. That sounds tough.
What do you think?
Yeah, that is what is currently implied by the short rate and stock market. Soft landing, both 100% priced
Hold on.
in.
The market is pricing in what?
So that's
5 cuts next year.
So both things can't possibly.
There's no way. There's no way these two things will.
What a soft landing and 5 rate cuts next year?
Well, so
can't have both?
12%. No, you can't. 12% earnings growth in the S&P 500 and 5 rate cuts. How would that even happen?
So which one is more wrong?
Well, the bond market is smart money. I don't know.
I don't know about that.
Well, that's what they say.
Yeah,
Bob,
I've heard that before, but I've also met people that are in the bond market, and I can't square those two things. So, all right, what do you think about this?
No, I mean the basic idea here is you can't have the type of strong growth that's being priced in,
right,
and these type of rate cuts.
Because why would they be doing the cuts?
Because why would they cut?
Yeah.
And I think there's some folks who think that in a soft landing environment you're going to have the Fed cutting. Because if inflation, we have immaculate disinflation, the Fed will cut into that. It's like the Fed is not going to cut interest rates when unemployment is at 3.5%. Not going to happen, right? Why would?
To what end? What would be the goal?
What would be the goal, right?
Yeah, we want to hit 1%.
Right, exactly.
Okay.
Like there's no reason to further stimulate an economy at secularly low unemployment. And so basically what this is showing is that one or both of those things is likely wrong. I think probably both of them are wrong in the sense of it's a little too bullish in terms of what's likely to happen on the equity side, on the earnings and growth side, and probably a little too bearish on the bond side.
Have we ever had something like this before, though?
No,
it's unprecedented.
No, there's no, we're not going to have something.
But this is so emblematic of bond investors and stock investors.
The pessimists and the optimists.
Exactly.
Right?
Well, if you're investing in stocks, you have to lean to the optimistic side. Otherwise, what are you doing? Why are you taking risk if you don't think it's going to work out?
Is this just saying, though, that the yield
curve
curve is telling us that they think short-term rates are going to come down? Like the inverted yield curve, is that all the bond market is saying, is that we're predicting short rates are going to fall eventually?
Well, yeah, just important to recognize all an inverted yield curve is just pricing. There's nothing more magical about an inverted yield curve other than the asset. The bond market is basically saying there's going to be cuts, meaningful cuts in terms of monetary policy in the future, and that seems pretty unlikely. And I think the interesting thing for a 60-40 investor, when you look at this, is that this is bad all around for a 60-40 investor, because if that growth doesn't come for an equity investor, stocks won't perform stocks will underperform. And if those cuts don't come, bonds are going to underperform, right? Because
underperform what?
Are going to sell off, right? Because if what ends up happening is the Fed doesn't ease the way that's currently priced in, bond prices are going to go down, right? Yields are going to rise, prices are going to go down. And so what you're seeing is actually a combination of dynamics that are particularly bad for the 60-40
But isn't the
investor.
40 in T-bills right now, and that's the best place to be?
I mean, sure, it some people might be
for a while, but isn't
how many real money managers are out there saying, let me tell you, 4% bonds, right? Never seen anything like it in my career.
Right.
Best deal out there, one-way trade, right? Only gonna return you
T-bill is 5.75.
Well, that's what it's funny to me is that talking historically, people are saying if you look at stocks relative to bonds, stocks look expensive because bond yields are 4%. To what I say is 4% is still low. Like throughout the 90s, the average was like 6.5% in the 10-year, right? And so I don't think investors think about it that way in terms of relative attractiveness between stocks and bonds and say 4%, I can get that. Why wouldn't I put all my money in here? I don't think allocation decisions are made like that.
Yeah, well, I think what's happening is that people, this goes back to what we were talking about before related to the bond market and the risks of a sell-off, is 4% is high relative to what you've seen over the last 15 years.
So if you're using recency bias, then it is high.
But that's what the bond market is doing, right? And if you hadn't lived through what the bond market did in 10 and 11 and saw how badly the bond market mispriced the depression, it wouldn't be in your mind to then say, well, look, they can just very badly misprice.
What do you think about this?
Inflation
what do you think about this dynamic? They, not on purpose, but they turned the short-term treasury market into almost like a retail investor market. So the only people excited about a 4% 30-year bond are insurance companies. They're locking in an offset to a liability that they know is coming due every year. That makes sense. Why aren't they taking the 6? They don't want the roll risk. They'll just take the 4. They know it's there. Period. End of story. The 6-month T-bill between 5.5% and 6%, we're now creating apps, or existing apps are creating retail products, getting people excited and marketing T-bills. That's something I've never seen in my career. And I was around in the 90s when rates were much higher. That's a new phenomenon. And I don't know if it means anything in terms of the pricing in the bond market, but it's definitely a new participant.
It's also a demographic thing, though, right? The boomers who are retiring have craved this yield for 15 years, and it's finally here, and they're going, give me all of it I could take, right?
There's an interesting dynamic going on at the other end of the curve, the long end. Bill Ackman came out last week and said that he was shorting the 30s, meaning he's expecting yields to continue to go up. There's a great chart from Bloomberg showing investor types. John, chart on, please. Investor types have wildly different bets on maturities. Different bets on treasuries. Hedge funds short longer maturity notes. Asset managers long. This is an interesting tug of war.
So the pink is asset managers, pros.
So professional bond managers,
they're buying the longer dated.
Are buying all of it. And hedge funds are saying, you dumbasses, you're about to
they're selling it to them.
You're going to get run over.
No, that's exactly right. Now, there's always some risks in the futures market that you're not getting a holistic sense of what's going on. But this data does align with what we do at Unlimited is we basically infer using technology how hedge funds are positioned. And we're seeing exactly the same thing, which is that hedge funds are basically as short bonds as they have been in a long time, underweight duration. And the reason why that is they're looking at this confluence of dynamics that we're talking about, the existing pricing, and saying, in one way or another, we're likely to see higher bond yields first before we get to a point where the economy tips over and we get into a recession. So they're betting on this picture. The smart money is basically saying we're going to have higher yields. The the
other money.
The other money. I don't want to piss off too much money here.
So hedge funds are bearish. I mean, so you have a great chart showing. So they're bearish because, well, this chart shows that they're betting on the 30-year rising.
Yep. Which
actually is interesting because that can be maybe a forecast of economic strength. But whatever.
But these are extremes, though. You said asset managers taking their own net bullish positions on the long bond to an all-time high. Is that right?
That's in Bloomberg.
Yeah.
Yeah. That's what the data shows in terms of contracts. And I think that's right because if you ever flip on Bloomberg and you get a bond person in there, they say 4% yield, best yield we've seen in ages. Tough to beat that 4% yield. They just like line them up. They just all come in.
So just for the audience, going from 4% to 5% on that with that much duration would be messy.
Traumatic.
Yeah. Pretty messy.
It would be tough.
Yeah. So not only are hedge fund managers bearish on bonds, but they're bearish on stocks. You've got a great chart showing you overlay the S&P 500 cumulative drawdown versus the 12-month hedge fund beta to equities. And you said with the current equity beta of 0.2, hedge funds are about as bearish on stocks now as they have ever been.
Right. Yeah. That's what you can essentially look at. The gold line here is how sensitive hedge fund returns are to equity market returns. And so the lower the sensitivity, the less equity market risk that they're taking on. And this kind of goes back to our earlier conversation, like what hedge funds perform well because what they know how to do is to cut equity risk when times are tough. And that's exactly what you see in the 2000 cycle as well as the 2008 cycle.
But times are not tough right now.
Well,
wait a minute. These are two major bottoms. The last time hedge funds got this negatively exposed to stocks
went down 35, 40%.
Right.
Yeah,
so but then that's the beginning of 03, it looks like. And it's 2018, just as the Fed is about to pivot.
Based on these last two charts, what you're saying is hedge funds are positioned for a replay of 2022.
In several ways. Yes, that's exactly right.
Where
which is
the bond sell-off leads to a stock sell-off.
The bond sell-off leads to the stock sell-off.
Imagine we get that shit again.
What's that?
I'm going out of town. I'm not doing that again. It's enough already. No, listen,
That's exactly how they're positioned. But a big part of why they're positioned that way is because, again, connected to what's priced in, right? Because it's not just a momentum trade. It's saying what's priced in is a perfect soft landing, strong growth, low inflation, cuts in interest rates. And so even if we get moderately okay growth, it'll disappoint on the stock side and it'll put pressure on the bond market.
Awesome.
As the Fed doesn't hike. And that's why I say go to that 60-40. If you're sitting there with a 60-40 portfolio today, you're basically, this constellation of dynamics puts you back to that 2022
which brings us to liquid alts. Let's take, first of all, thank you for all that. Let's take like a 2-second, let's take a beat and explain to us what you're doing at Unlimited. And we'll talk liquid alts in general, because that dynamic that you just brought out is why the wealth management industry has never been more excited about having something else in the portfolio that's not 60-40. So they all want to be now, 50-30 and then something. And in the old days, it would just be a commodity sleeve because it was easy, and it didn't work. But now it's a much higher level discussion with even fairly unsophisticated RIAs. Everyone's all in on alts, so it's good timing. So tell us about Unlimited and where you guys play.
Yeah.
Unlimited.
Yeah, what I spent my career basically in the 2 and 20 business. 2 and 20 meaning 2% fixed fees, 20% of carry, which is typically how hedge funds, private equity, venture capital is structured. And I basically looked at that, and my co-founder Bruce from Queens College, we basically looked at it and we said, look, we've got a lot of experience in this business. I bet we could create technology that allows us to look over the shoulder of the managers, see what they're doing, hedge fund managers, venture capitalists, private equity investors, see what they're doing in close to real time, take that understanding, translate it into long and short positions, package that in an ETF, and essentially make that available to any investor, right? Because if you're a small advisor running $100 million with dozens of clients, you don't have $1 million checks to invest in the top hedge funds in the world, right? Like that, you just don't have access.
That's always
to those
been
sorts
my
of investors.
personal argument against it. And talking to clients, like, if I can get you into hedge funds, they're probably not the right ones.
They're not right. Any hedge fund that'll take $1 million check is not a hedge fund you want to invest in.
So, okay.
That's all there is to it, right? Because the good ones don't need your money.
So the space has evolved. It started with fund of funds, this idea, and then like Skybridge kind of came along and said to Merrill Lynch, yes, your clients are dentists, but dentists deserve Stevie Cohen. And that was a really great pitch, and it worked, and they raised a ton of money. But now it's evolving, and you guys are doing this with ETF wrappers, and you're eliminating a lot of layers of fees and a lot of friction.
Right. I mean, most of the funds that folks who are advisors have access to, right, are negative selection, rack rate fees because you're a small scale investor. Often there's additional fees on top of it.
Platform fees,
marketing fees, all that stuff, right? Fees on top of fees on top of fees.
Commissions to brokers.
Right, exactly.
Yeah.
And so so there's been like a lot of increase in access to alternatives, but in a way that is actually bad for investors because they're getting access to bad products and they're paying through the nose for it. And so what we said is—
Let me stop you though. Before you say how do you define bad? Bad meaning the prior track record wasn't good?
No, bad meaning investors for most products in this like access to alternatives push that has happened are worse for investors. Investors are worse off for having those products available in the market than not having them available.
Because of the specific funds they could access.
Because of the funds that they can access and the fact that they're paying extremely high fees.
Okay.
And because they're taxable, they're paying high taxes in those structures.
On top of it all.
On top of it all.
Insult to injury.
Right?
Yeah.
And so, I mean, say you invest in a product that has a 10% expected return. The manager takes 2 and 20. The platform takes 1.
The advisor takes.
The advisor takes 1.
Trading costs.
And don't forget, the government takes half of your profits. And now we've gone from a 10% returning asset. Everyone has been paid, right? Except for the investor who's getting 2%.
Yeah.
Literally 2% net of taxes and fees.
He gets to walk around his backyard barbecue and tell his friends that he's investing in hedge funds.
That's right.
You're missing like the experiential part of it.
But then why? But
what's the Yogi Bear? I would never join a club that would have me as a member. Yeah. I worked in the endowment space for a number of years, and I was under like $1 billion fund, and even at that level, we could not get access to the best hedge funds.
Right?
And if you're not in the top, name a number 20% or whatever it is, you're right. It's pointless to be in them.
So you guys saw that conundrum and
we basically said, look, we've managed money and we've built the proprietary strategies in these funds. We know what they're doing. We can build technology, and it's been a lot of advancement in terms of the technology that we can build to allow us to look over the shoulder of the managers, see what they're doing in close to real time, and then we can take that and translate it into long and short positions in liquid securities that can back an ETF. And the benefit of that is, one, we can charge a lot less, right? Because we're using technology instead of having to charge 2 and 20.
John, chart on aggregate AUM by fee.
These are wild charts.
And number 2 is we can do it also in the ETF wrapper, which I probably don't have to convey to all of you why the
Tax
ETF wrapper
efficient.
is the way to go. Tax efficient, liquid, transparent.
So you're replicating existing strategies or existing managers.
That's right. We're replicating
inside of an ETF wrapper.
We're replicating the gross of fees returns of we're seeking to replicate the gross of fees returns of the aggregate hedge fund industry.
That's the mission.
And that's the mission.
That's the tracking error that you're trying to minimize.
Exactly. And that's the thing is, hedge fund managers are pretty good, right?
Before fees.
Before fees, before taxes.
So what are we looking at here?
Well, so here's the thing is, I'm sure many advisors who might be listening to this, their eyes glaze over like, thank you for talking about liquid alts.
Not my audience.
Those products.
No. My audience they want to hear this shit.
Those products in general have sucked.
Yeah.
Right?
Yeah.
Decades of sucky product.
Yeah.
And let's just boil down to why we've
only written 1,000 collectively 1,000 blog posts.
Do you think the biggest part of that is not just the fees, that it's hard for some of these funds to quantitatively track those? Or do you think that?
Well, I think there's a couple issues. One, the fees are way too high.
Yeah.
Right. This is crazy that the fees,
Let's describe this. You're saying most liquid alt fees are too damn high, but there are good ones if you look for low fees and high alpha share. Why didn't I think of that? Low fees and high alpha? Yeah, that's what I should. It's hard.
Most of the fees are paying 3.5%. Is that fixed or is that all in?
Fixed plus an amortized load.
But it's hard to find high alpha and even harder to find it that's not 3 and 30. Like, it's hard.
That's right. But here's the problem is if you're charging 300 basis points of effective fees for the small investor.
That's insurmountable.
You
can't get, no matter how good the manager is, you can't.
Wait, there's more.
And to be clear, the managers are bad too. And the reason why that is, let me just
next chart.
Let me just make it, boil it down. If you were good enough, most of these strategies are proprietary strategies. They're not replication strategies. They're people making their own bets, right? And if you were good enough to make bets in markets, why would you be running a mutual fund?
No, you'd be running your own money.
You'd be running your own equity long short fund and charging 2 and 20.
Yeah.
So we've got the worst of active managers charging these ridiculous fees, and the outcome is that you get very bad outcomes for the investor. The thing that's incredible about it is no one seems to connect the skill of the manager to the fees, right? And that's because most of these products that have been successful have basically been marketing schemes. So here, the top chart basically shows you gross alpha. That's basically just saying how much are these managers delivering relative to just investing passively in the markets? That's on the x-axis. On the y-axis is the fees. You would expect good managers to earn higher fees, unrelated.
That's wild. It's all over the place.
Unrelated.
Have you seen Michael's numbers? I'm just saying. There's something good. There's something good taking place.
It's all over the place. So then you also show the best managers should also have the highest AUM. But it's totally related.
Totally unrelated.
It's crazy.
Totally unrelated. And I can appreciate if you're an advisor.
You need another axis that's like Iris own speaking gigs.
But just like, for the audience, we're looking at AUM versus alpha of a 60-40 net, and there's nothing.
There's nothing there. There's no signal.
No relationship.
Yeah.
But imagine you're a small scale advisor. How do you figure out who the good advisors are? Because the BlackRock person walks into your office and says, "Hey, I got a fund that's got $5 billion in it. Isn't this a good idea?
It must be great.
It must be great.
$5 billion.
But
you can't.
It's charging 300 basis points and delivering no net alpha.
All the firms have this issue. Like J.P. Morgan wants to give hedge fund like product access, wants to give their investors, if they want it, access to alternatives, liquid alternatives. And it's noble to want to do that.
Absolutely.
It's risk. Why? Like they torture themselves to do this. So it's not like it's all upside. So they want to do that. The thing is, in order to do that at scale, it's going to have to be a $30 billion hedge fund.
That's right.
Hybrid. Now, you might take that same hedge fund and look back 15 years and it has an amazing track record. Most of that track record was built when it was $300 million.
Yeah. We could go on that. Like, how many of these multi-manager funds claim to have 2 Sharpe ratios, 0 beta?
Yeah. Couldn't earn them at the current size, though.
And earn them with a $500 million track record. And now they got $50 billion in them. We're not going to name names, but that track record is irrelevant.
So, Bob, it's a difficult space. I think even the people in the space would agree. You can't disagree. So your mousetrap, though, like your idea is if we get the fees low enough that they're not insurmountable, and we replicate what the better funds are doing to the best of our ability, it's not perfect, but it's way better than the industry standard.
That's exactly right. Like,
okay.
There's no
you should
more,
hire me to explain this.
Exactly.
Okay. I like it.
Yeah, there's no more durable alpha than being cheap.
When did you launch?
October.
Okay. Now, when you do start crushing it, are you going to raise fees? Or
no.
Okay. So this is going to be the product.
No. My goal would be that we should actually be bringing fees down.
Don't do that. Not yet.
You
got to hire more people, though. Give yourself a runway. You got to seriously, if it works.
No, I know, but that's the idea. Is that if you start to get to scale, if this is a $10 billion type,
how much money is in traditional hedge funds right now? 3?
5 trillion.
5 trillion.
5 trillion.
And to your point, the best hedge funds that get to that level and then they have all this asset, they have scale and they should be able to lower fees, but they never would because they have the track record. They never will.
Right,
also, in that world, lowering fees denotes lack of quality.
Right.
Like you don't want to send that signal to your investors.
Is that a Griffin good or a Giffen good or a something good?
Veblen good.
That's a Ken Griffin good.
Yeah,
it's a Ken Griffin good. Yeah, look at you. This guy's clever. All right. We got to move because I can't believe how fast the time went.
We're keeping.
We're going to keep him longer.
No, we already kept him.
All right. Let's do this real quick.
I can keep going.
Let's do this real quick. 13% of crypto hedge funds have shut down so far this year. Understandable. The reasons for the closures, weak performance and difficulties in accessing banking services, both true. Furthermore, crypto funds generated on average about 15% returns in the first half of 2023. Bitcoin is up 77% over the same period.
I mean, that's what did they do in 2022?
I don't know, but probably not great considering how many lawsuits and arrests there have been. I'll just guess
I'm just saying
it
returns.
wasn't their best year ever.
Returns. It's tough.
97 of the 700 existing crypto hedge funds tracked have closed in 2023. The FTX collapse obviously played a big role in that. The ones with the market neutral strategies performed the worst, generating a 6.8% return for the first half of this year. This thing with the hedge funds, my point is, it's remarkably consistent across asset classes. Even in crypto, the industry is delivering 15%. You could have just bought Bitcoin. Like, it's the same. You could say it with credit. You could say it with stocks. It's just a tough business to try to outsmart the markets all the time.
You're trying to outsmart everybody. It's hard. Whatever the asset is, it's hard.
It's always going to be very hard.
Say I know something that everybody else is mispricing. It's tough.
Repeatedly.
Yeah, it's tough.
Repeatedly.
Yeah, for sure.
Okay. I wanted to
market neutral in crypto just sounds like a
market neutral
trap.
in crypto is what do you even?
I don't
what
know.
is the point of life?
I don't. That's an oxymoron. I don't get that.
You don't have to have a strong opinion about this. I thought this Wall Street Journal story about Two Sigma was interesting, and it's two founders that have been at war with each other, but neither one will leave. And you're laughing as though you know some inside stuff here.
I don't know anything about them in particular.
All right. So
I get it.
I don't know the guys personally at all. It's a $7 billion fund, a $60 billion fund. They mint money. The two founders have the two votes. There's basically two votes. So there's no tiebreaker here. One of them's going through a divorce. The wife is going to get billions of dollars and maybe the vote. I don't really fully understand the issue. But just generally speaking, we were talking about the culture of Bridgewater before. They've now lasted long enough where they're like one of the older firms in the industry. This firm's been around for a while too. Somehow it keeps going. I keep hearing about how important culture is. Here you have a firm that actually had an SEC filing telling the government and investors, quote, "We are unable to make basic management decisions." And yet the portfolio's fine, the fund is fine, nobody's leaving. So maybe culture is not the most important thing if something like this could exist.
I think
Thoughts?
That the benefits of a systematic approach.
It's
right?
another systematic
It's
firm,
another
like
systematic
Bridgewater.
firm, and when you do that, there can be a lot of drama on the outside, and as long as the people who are responsible for running the money are sitting there making sure the trades get done, and the money gets managed appropriately,
So they're systematic on the inside, and then on the outside, it almost doesn't matter.
It can be chaos, right?
Okay.
Who gets the 3% mortgage in this divorce? Don't you remember, it used to be stay together for the kids. Isn't it stay together for the 3% mortgage now?
I don't know. They seem to be ticking along. This has been going on for a long time, and no issues. So maybe systematic is the way to go after all. What do you think?
I think it takes a lot of. I don't know if it's a good or a bad thing because it also means people can spend a lot of time on the drama and the conflict.
Yeah, it's systematic.
Because
There's plenty of time for political infighting.
Right, so you can waste a whole heck of a lot of time doing that stuff.
Fair enough. Did you have fun on the show today?
It was great.
All right.
Yeah.
I thought you crushed it. We're going to turn on the recording in a little while. I just wanted you to warm up a little bit and just get a sense of, the give and take. But you feel good now?
I feel great. I can do this for another hour.
We do this thing called favorites to end the show where we tell the listeners what they might be missing. Books, TV shows, movies.
Let me start.
Podcasts. Michael, why don't you start?
Today. So I listened to Animal Spirits yesterday. That's a podcast. That's a podcast for me in bed.
Kid, his favorite is his own podcast.
Hang on. I haven't listened to our show. Do you still listen every week?
Occasionally.
There's no way you're replaying that.
I haven't. I used to listen for the first 5 years. I listened to every single episode, and I haven't listened to them a year. Maybe. We're pretty good.
It's unbelievable.
We're pretty good.
Have you ever in your life encountered
That's a
anything
good
like
podcast.
this?
It's fun. I had fun. So I recommend that if you haven't listened.
Michael recommends himself.
Have you heard the editing on it? I mean,
the editing is top notch.
Is amazing.
Okay, but in all seriousness, and I am serious about Animal Spirits, Amazon Prime has a documentary called Destination NBA, a G League story.
Oh, I want to watch
Which is great.
Did you watch the whole thing?
Yeah, it's an hour and a half. Scoot Henderson is heavily involved. There's this guy, Gabe York, who is struggling to make it to the league, and it's just
Is this Bill Simmons?
He was an executive producer. If you're a basketball fan, sports fan, it was great. Great.
Are you basketball fan at all?
Last time I was into basketball was the Bad Boys
in the 90s.
Oh, the Bad Boys.
Yeah.
Wow. Not even Ben Wallace.
One of the most underrated teams in history. They got sandwiched in between the Lakers and the Celtics and the Bulls.
I know.
They beat Jordan. They beat Magic. They beat Larry.
They beat everybody.
Yeah.
They could have had 3 or 4 titles.
They were great.
But they didn't.
Ben, have you brought us a favorite today?
So wife and I finished Outer Range on Amazon Prime. I'm a big Josh Brolin guy going back to his Goonies days.
Yeah.
And it's Yellowstone meets sci-fi.
Okay.
And
Yellowstone Star Trek.
Where do you watch this?
It's on Amazon Prime. It gets a little weird.
Say it again. Outer Range?
Outer Range.
Okay.
Yeah, outer space, right? It's Yellowstone with a sci-fi element, and it's bizarre, but in a good way.
Okay.
We
I'll
finished
check
the
it out.
first season, and I can't wait for the second season now that the first season's done.
When was it? When did it originally come out?
It's a while, like over a year ago. It just took a while.
What's your favorite Brolin performance outside of Goonies? He's been in a lot of good shit in the last 10 years.
Gotta be No
Obviously.
Country for Old Men, right?
No Country for Old Men. He's like the best part of the movie.
He plays a kind of a similar character
And
in this.
Sicario.
but- Yeah.
He's great.
He's good. But the way he rode the bike in Goonies when he's holding on to the side of the car, right?
Yeah, he saves the day.
He's the man.
I mean, they would never have found One-Eyed Willie's treasure without the heroics
Wait, was Josh
of Josh
Brolin in Wall Street with Shia LaBeouf? Yeah,
Yeah,
right?
he was.
Yeah, he was
He's the
like,
bad guy.
Yeah, he was the bad guy.
He's the best part of one of the worst movies ever made.
Pretty bad.
So, all right, well done. Bob, have you a favorite for us?
I guess, this is going to be pretty nerdy, right?
We'll see. I'll be the judge of that.
This American Life.
Okay.
NPR?
Pretty nerdy, right?
Well, you're Midwestern. Isn't that a Midwestern thing?
That's
This American
from
Life?
Chicago.
Yeah.
Driving around in the old Pontiac Bonneville.
Yeah.
Was there a specific
With my
episode?
dad. Yeah.
series?
Just 2 episodes ago, I Just Can't Quit You is about a guy who was trying to quit smoking. Amazing story. The intersection of science. There's all this pop science about how to quit smoking.
I'm rooting for tobacco in this
People
situation.
have.
Wait, how did he quit? Did he die?
No, he lost.
He struggled. But it's pretty amazing.
So it's an uplifting. Okay.
It's a really uplifting tale about how about that experience and about how pseudoscience can make lots of money and is just totally useless.
Okay.
Feels like a
Speaking
view
of
the world today.
in a similar vein, one of my favorite albums to come out this year, Post Malone's new record came out 2 weeks ago.
That's about as cool as This American Life.
So I think he's going to kill himself. I'm like,
Whoa,
this
come
is the
on,
album. This is
dude.
the album cover. I know some of this is shtick.
Oh, you think?
Do we have any more,
Come on.
or there's no need really?
Oh, there we go. Yeah.
So he lost a lot of weight, which is great. I saw him live in Austin last fall, and he was awesome on stage. There's no DJ, there's no band. It's just him on stage in a spotlight.
Wow.
And the crowd loved it. And he has so many hit songs, like maybe 20 hit songs that everyone in the audience knows every word to. He's like really, his music though has gotten very self-destructive. So he put out like 17 songs on this album. Every one of them is about like smoking butts till the sun comes up and drinking and falling on the floor and being hungover. And I'm like I'm a little bit concerned, unless it's all performative and he's like at Jamba Juice, all day. So, but anyway, the music is great. And I thought like maybe it's just all an act and he's not quite as far gone as it makes him sound. So any reaction at all from anyone?
Sure, I'll jump in. I don't know much about Post Malone, but
I know you don't listen to a lot of music that's
but-
come out since 1991.
right, that's true. No, 1998 was my cutoff date.
Okay.
But I heard Post Malone. He was on Howard Stern a couple of years ago, doing Nirvana, and he was
he's
f***ing
ridiculous.
amazing, like super talented.
I want to mention the Jones Beach Amphitheater. Have you ever come to a show at Jones Beach yet?
No, but he showed me it before. I've seen it.
I texted Josh on Saturday. I said, "How was the show?" And he goes, "It's good. The weather was great too." And I said, "I meant the CNBC show."
Yeah. So I'm
Who
not
did you
like
see?
I'm not a Goo Goo Dolls fan.
Yeah, that's okay, dude. No shame. Admit it.
I'm really
Slide.
not.
You love
It's
slide.
honest-
Oh.
I left early. It's really not my thing. But my wife and all her friends,
I mean, Google
they
those.
love it.
No offense, I know they're super lame.
They have really good songs, but it's not my scene.
You're checking out Matchbox
That's a
20
nostalgia.
next?
Yeah, that's a nostalgia
exactly.
show. That's a
It's
nostalgia
not-
show.
Yeah, no, that's 100% what it is. But it's the important part is we're all in our late 30s to late 40s. Our wives love it. to see them have as much fun as they're having, who gives a shit? Get past yourself. That's what I tell myself in the mirror.
Are you playing this to
Shaq? No. So it was cool, but the amphitheater is the star. It doesn't matter who's on stage, honestly. Venue. It's really beautiful. Like, we went, it was 75 degrees, it was breezy, there was no humidity, the moon is out, there's waves crashing all around, there's boats in the background, and they get huge acts. So I just, I thought I'd throw that out there.
Oh, there it is.
Let me say.
That's where we live.
So I was sitting literally right there.
Can you pull your jet ski up right there?
You can't.
It's
in Zach's Bay, but you can't get that close with a boat or a jet ski.
That's an amazing view.
There's like police in the water.
But they get, like, we saw last summer, we saw Chris Stapleton there. They had like 100,000 people. Almost nobody had tickets.
I saw Live in Bush.
They just were walking around.
Together.
I've seen Aerosmith here. I've seen like big stuff. Anyway.
I saw Zeppelin there.
Shout to Jones Beach. All right, that's it from me. Hey, guys, make sure if you love the show, ratings, reviews on your favorite podcast platform. What do you got?
We have one. We have a good review.
Let's do it.
It's from Word Scammed.
I'm about to turn into a pumpkin, so
and
with it.
They wrote one of the 3 best podcasts of any genre. I've tried over a dozen financial podcasts and countless podcasts of other genres. Almost all financial podcasts are hard to listen to because they're boring. TCAF and its sister podcast, Animal Spirits, are different.
You see that in my sister podcast. What's up?
They are entertaining while being educational. The Compound and Friends and Animal Spirits are the 2 best financial podcasts, bar none.
Told you.
They are both fantastic.
Did I not say it?
They can say a lot more, but I'm going to skip to the end. The last thing they say is, I listen to many podcasts and am constantly looking for more to add to my rotation. There are only 3 podcasts in all genres that I've religiously listened to for years.
A lot of genre talk here.
I love this guy.
Bill Simmons, Animal Spirits, and The Compound and Friends. They are my Mount Rushmore of podcasts.
Wow.
I can't express how much I appreciate the effort these guys put into the show.
Thank you so much. All right, we're going to let Bob get out of here. But I just want to tell you, like, you have been an incredible guest. I hope
Thanks for having me. This is fun.
Will you come back?
Yeah, of course.
Yes?
They're amazing.
Right.
Thank you.
What are you doing tomorrow? Bob, you're awesome, and I want to wish you all the best of luck with Unlimited. I love the idea of what you're doing.
HFND. I'll shout it out. Check it out.
Yeah, I'm gonna dive in and learn more about it. But just thank you so much for coming by.
Thanks for having me.
We really appreciate it. Ben,
great.
Thank you, man. You going out for a show with Michael tonight?
Go to see some comedy.
Comedy Cellar.
A little comedy?
Yes.
We're actually going to the Fat Black Pussycat, but same thing.
Okay.
All right, that's enough of that. All right, listen, hey, compounders, make sure ratings, reviews, like us, tell your friends. We appreciate you. See you next week.